All right, joining me now to talk about this new trend is Ashishkumar Chauhan, who's the Managing Director and CEO of Bombay Stock Exchange, but more importantly, someone who has seen this market very closely for over 2 decades. Ashish, we as a country seem to have totally failed in our attempt to bring retail investor interest into equities, isn't it?
In a sense, I think there are two sides of the same coin. Basically, the way we look at it is today, despite all sort of gloomy scenario being given, the way we look at it is today Indian stock market capitalization is higher than all the bank deposits put together, which means something has happened over last 3-4 months that the Indian market cap has taken over the bank deposits. And it's a very interesting perspective, which is, I think, the other side of the same coin, that we may continue to feel that the Indian investors, the retail investors, has not participated as much. And I would agree with that last 20 years, what we have done is, we have done a great job in automating our systems, cleaning up in terms of the transparency, fairness, efficiency. Now I think the time has come, an inflection point has come where we can take the penetration from 2% to 20%. And basically, how does this work? You know, today India's demographics is very, very interesting. More than 50% Indians are less than 25 years old. And all of them will require basically investment in financial instruments, especially stock markets, which provides, in sense, hedging against inflation for their old age, for their pension, for their health, for their children's education, and so on and so forth. And all these youngsters basically are going to stay most probably in nuclear families. So the traditional joint family insurance is also going away. And that's where the attractiveness of this market for the retail participation is becoming very, very interesting. I mean, I have also been giving this example of the telecom industry that 7 years back, we had a 4% penetration. And the technology distribution, the regulatory framework allowed the telecom industry from a very low 4% penetration to go up to almost 100% penetration. Practically every Indian would have a mobile phone. And similar things, at least from 2% to 20%, is actually achievable over next 10 years. And that would basically bring in huge growth in what I call the savings as well as the retail participation.
Ashish, let me just get back a bit. You know, 20 years ago, 15 years ago, we probably had more penetration, retail penetration into equities. The country's come a long way since then. The reforms have happened. You talked of the demographics. That growth has been seen across various sectors. Equity, we are actually going backwards. You talked about having the best infrastructure in place. Our cost of transactions is among the lowest. So, you know, while we can talk about the telecom, etc. experience, the fact of the matter is that we have totally failed to bring in retail investors into equity. And I want to ask you, what are the 2-3 things that need to be done to ensure that there is higher participation? 3% of financial assets, is that what we've achieved in 20 years of reforms?
The way I look at it is there are two aspects which we need to work on. One is what I call financial literacy and financial inclusion. How do we train our students even from class 1 into languages, in physics, chemistry, in geography, history, everything. But we don't train them, or we don't even teach them, even tell stories about how to manage funds, you know, how to live life which is secure from financial perspective. And that is one thing which we need to work upon as a society. And the exchanges, the regulators, the Ministry of Finance, everyone is contributing. But I think there is an onus on the society to also sort of educate its people, do financial literacy, financial inclusion, to ensure that the people understand what is right and what is wrong in terms of financial investment. Second part is, over last 8-10 years, without our knowledge, we have started giving what I call tax disincentives for stock market investments vis-a-vis other similar investments in organized markets. For example, today we have a STT, that is Securities Transaction Tax, that is levied on Indian stock markets, which is although it is very small in basis points, overall it works out to more than 5,000-6,000 crores. I think in a base year it was probably more than 9,000 crores or around close to 9,000 crores. And if you look at the comparable markets of gold or silver, which are actually financial instruments, and especially the derivatives on them are basically financial instruments. All derivatives are considered financial instruments. they are not actually even having similar taxes. Similarly, currency does not have a tax like that. Even electricity trading or interest rate futures on the exchanges. So the way we look at it is, unknowingly, what we have done is the productive capital. Ultimately, India imports around $60 to $70 billion of gold every year. And that is basically getting into the jewelry and vaults. It's getting no job creation. In India's basically need for next 20 years to create 1.5 crore job every year. That is 30 crore jobs need to be created for next 20 years. And that can be done by investment in stock markets, because investment in stock markets actually allow the job creation, investment in services company, in manufacturing companies, infrastructure, which is not going to happen with gold. And somewhere on the line, by not putting a tax, a similar tax on the commodities transactions or currency transactions, and putting such a large tax, especially $1.5 to $2 billion tax on securities market transactions, what we have done is we have slowly moved the people who used to invest in stock markets into commodities markets or real estate or other things which may be not productive. So the way I look at it is, how do we rework our tax framework? How do we make it more rational, that what we want to achieve as a society, that is more job creation, more productive investments, how does that happen? And how do we sort of rejig our overall framework of taxation so that more and more people are actually invited to participate? They are aware that this is one sort of asset class which can give you a longer term basis, very high returns, provided you stay longer term. And those are the kind of discussions we need to be having even through media.
All right, Ashish, thanks very much for coming by. Of course, this is not something that is going to change in a hurry, but I guess it is in the best interest of the country and the government to take a closer look at these dwindling numbers of retail participation in equity markets. Let's take a quick break here on the